The number your 401k statement shows you is not your retirement number. It is the number you have today, not the number you'll have at 67, not the adjusted after tax, after inflation, after fee number you can actually spend without running out of money before you run out of life. And the third thing, the thing that never makes it into the brochure, is that even if you've done everything right, contributed every year, taken the employer match, picked decent funds, the math still has a structural trap buried inside it that most people don't discover until they're 64, and it's too late to change course. Here's what this video is really about. The 401k is not a retirement plan. It is a tax-deferred savings account with a retirement sticker on it. And the entire financial industry, your HR department, your broker, the government, all have very specific incentives for you to not notice that distinction. Not because they're evil, because it's profitable when you don't notice. There's a difference between malice and incentive. The result looks the same from where you're sitting. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They skip sequence of returns risk entirely and ignore IRMA bracket cliffs that can blindside you in your 60s. It uses BlackRock and Vanguard modeling logic to expose the real weak points in your specific plan. And I only ask for your email to send the report because I don't store any of your financial data on my end. Link is in the description. Now, I want you to hold one image in your head for this entire video. Your building is on fire. Somebody installed a fire extinguisher by the front door. That extinguisher is real. It's certified, it's functional, and in exactly the right circumstances, it absolutely works. But the extinguisher was designed for a small kitchen fire, a pan that got too hot, a short circuit on the stove. It was never designed to protect the whole building from a 30-year slow burn that started inside the walls 2 decades ago. The 401k is that extinguisher. It is not fake. It is not useless. But if you are counting on that one extinguisher to protect everything you own across 3 decades of retirement, you need to read the label more carefully. I'm going to keep coming back to that extinguisher, and specifically to the label, because the label is where this gets genuinely uncomfortable. In a few minutes, I'm going to show you the scenario where doing everything right, maxing out, taking the match, leaving it alone actually accelerates the problem. Not slows it down, accelerates it. But first, let me establish just how broken the basic math is, because I don't think most people have actually run the numbers without someone softening them first. The average 401k balance in America right now, according to Vanguard's How America Saves report from 2024, is $134,000. The median is $35,000. That means half of Americans with a 401k have less than $35,000 saved for retirement. That is not a retirement number. That is a used car. A used car that you can't withdraw without a penalty before 59 and a half. But okay, let's be generous. Let's say you are not the median. You're the ambitious one. You've been contributing for years. You take the employer match. You're putting in 10 to 15%. You're not touching it. Let's run the actual math, because this is where the first shock hits. The contribution limit for a 401k in 2025 is $23,500 per year. Under 50, that's your ceiling. Add the most common employer match structure, 50 cents on the dollar, up to 6% of salary. And if you earn $100,000 per year, your employer contributes $3,000. Total annual contribution, $26,500. Do this perfectly for 30 years. Start at 35, retire at 65. Market average is 7% annually conservative based on long-term historical data for a diversified portfolio. After 30 years, you accumulate roughly $2.7 million. That sounds like winning. Here's where the label gets interesting. That $2.7 million is pre-tax. Every single dollar you pull from a traditional 401k gets taxed as ordinary income. Not capital gains rates, ordinary income rates. So at a 22 to 24% federal bracket, plus state taxes in most states, you're surrendering somewhere between 26 and 30% of every withdrawal before you spend $1 of it. Apply the 4% rule. The standard guidance for sustainable withdrawal to make money last 30 years and 4% of 2.7 million is $108,000 per year before taxes. After a 26% effective rate, you're working with around $80,000 before healthcare, before the unexpected, before inflation erodes the purchasing power of that $80,000 every year. You're alive. You did everything right. You're in the maybe this is okay, maybe it isn't zone. That is not a margin of safety. That is a margin of hope the market cooperates and your health holds. And here's what I want to flag before we go deeper, because this is the first reversal. You think the problem is that people aren't saving enough. That's the conversation everyone has. Save more, start earlier, take the match. But actually the problem isn't the savings rate. The problem is that the vehicle itself has structural limitations that no savings rate can overcome on its own. You can max the extinguisher to its absolute capacity, and it still doesn't change what the extinguisher was designed to do. Now, let me introduce someone. His name is Craig. Craig is 66 years old. He spent his career as a civil engineer, reliable income, union benefits for the early years, corporate job for the back half. He took the maximum employer match every single year without fail. He never touched his 401k. He picked a target date fund, set it, and forgot it. In 2023, Craig retired with $1.4 million in his account. He had done everything the financial industry told him to do in the exact order they told him to do it. Craig felt like he had won. I'm going to come back to Craig because Craig has a problem that is already in motion, and Craig has no idea it exists yet. Here is the scenario I promised you, the one where doing everything right accelerates the problem. This concept is called sequence of returns risk. It is, without exaggeration, the most important mathematical concept in retirement planning that most people never encounter until they're sitting in it. During your accumulation phase, the 30 years, you're putting money in the order of your annual returns doesn't matter very much. A terrible year at 38 gets smoothed out over the remaining decades of compounding. The math is forgiving. The moment you start withdrawing, the moment you flip from accumulation to distribution, the order of returns becomes the entire game. Here is the number that lands this for most people. Take two retirees. Both start with $1 million. Both withdraw $40,000 per year. Both experience an identical average annual return of 6% over 20 years. The only variable is when the bad years hit. Retiree A gets a 30% market crash in year one of retirement. His portfolio drops from $1 million to $700,000. He still withdraws $40,000 he needs to eat, pay rent, cover healthcare. He's left with $660,000. That $660,000 now has to grow fast enough to sustain 2 decades of withdrawals. It cannot. The math breaks down around year 14 or 15. He runs out of money completely. With years still left to live, retiree B gets that same 30% crash, but in year 17. By then, 16 years of compounding have grown his portfolio substantially. The crash is painful, but hits a much larger base. He survives. He actually dies with money left over. Same average return, same withdrawal amount, same starting balance, different order. Completely different outcome. This is the part that doesn't appear in the HR enrollment packet. This is why the extinguisher metaphor keeps coming back. The extinguisher performs exactly as labeled in optimal conditions. But the fire doesn't consult your retirement date before it starts. A market correction doesn't check whether you just stopped accumulating. Sequence of returns risk is the mechanism by which a perfectly executed 401k strategy can still destroy your retirement, not because you did anything wrong, but because you were entirely dependent on one vehicle with no protection against the one risk that matters most in the one phase where you're most vulnerable. Check the label on the extinguisher. This risk is not listed anywhere on it. Now stay with me, because this next part changes everything about how you think about the structure of retirement accounts. By the way, hit subscribe if you're finding this useful. YouTube's algorithm genuinely buries channels that don't get subscriber signals. And if you don't click that button, there's a real statistical chance you never see this content again. It costs you nothing. It takes 2 seconds. And I've got a lot more where this came from. You think the problem is the market. You think the risk is volatility. You think the solution is picking better funds or timing things smarter. But actually, the problem is the architecture of the account itself, and I want to be specific about why. Let me talk about the tax trap, not the boring philosophical taxes are high kind of conversation. The specific, compounding, self-reinforcing tax trap that waits for people who successfully accumulate large 401k balances, because this is the one that doesn't show up until you're already in it. When you retire with a large traditional 401k, and let's use Craig's number, $1.4 million, you are not entirely in control of your withdrawals. Starting at age 73, the IRS mandates what are called required minimum distributions, RMDs. The government sets a schedule based on your account balance and your actuarial life expectancy. And every year you must withdraw a minimum amount whether you need the money or not. And you pay taxes on every dollar of it as ordinary income. Now here is where it starts compounding against you. Those RMD distributions inflate your annual income. And as your income rises, more of your Social Security benefits become taxable. Up to 85% of your Social Security income can be subject to federal tax, depending on your combined income from all sources. So your 401k forces distributions, those distributions raise your income, which makes more of your Social Security taxable, which raises your income further, which in some cases bumps you into a higher Medicare premium bracket. That program is called IRMA, the Income-Related Monthly Adjustment Amount. In 2024, a retired individual earning above $161,000 annually, including 401k distributions, paid roughly $340 per month more in Medicare Part B premiums than someone earning $50 below that threshold. The threshold is a cliff. You land a dollar over it, you pay significantly more. And you cannot negotiate your way off the RMD schedule to avoid it. So the scenario plays out like this. You save diligently, you built a large 401k, you're now 75, the government is forcing you to withdraw money you don't necessarily need. That money is pushing your Social Security into a taxable bracket. Your Medicare premiums are elevated because your forced income is elevated. And you're watching your account balance decrease, not because of market losses, but because of mandatory withdrawals and tax friction working in tandem. You worked harder, you saved more. You did exactly what the system told you to do. And the system's reward for that diligence is a compounding tax problem you couldn't see from where you were standing at 40. But Tom, what about Roth? Roth solves this. Roth is genuinely better for this specific problem. No RMDs, tax-free withdrawals. I'm not going to argue against Roth. But here's what Roth doesn't solve: the contribution ceiling. In 2025, the combined 401k contribution limit, Roth or traditional, is still $23,500 per year. The ceiling doesn't move because you chose a different tax treatment. And most workplace plans still predominantly offer traditional contributions as the default. Check your own plan. Most people are in traditional without having made an active choice about it. The point is not Roth versus traditional. The point is that $23,500 per year in a country where a median home now costs over $400,000 and healthcare and retirement can run $350,000 for a couple over 20 years, according to Fidelity's benefits consulting estimate, is a ceiling that the system never adjusted for the actual cost of living in America in the mid-20s. And this is the place in the video where I want to make the larger argument. Because everything I've shown you so far, sequence risk, the tax trap, the contribution ceiling, those are symptoms. The disease is structural, and it goes back to a decision made in Washington that most people never thought about. Before the 1980s, the dominant retirement vehicle for corporate employees was the defined benefit pension. Your employer promised you a fixed monthly payment for life, beginning at retirement. The employer managed the investment portfolio. The employer absorbed the market volatility. The employer bore the actuarial risk of your living to 90. You showed up, you worked, and at the end, you received a check every month until you died. The risk was the employer's problem. Then came Section 401, subsection K of the Revenue Act of 1978. originally written as a way for executives to defer bonus compensation, not as a mass market retirement vehicle. But companies noticed something almost immediately. A 401k plan is dramatically cheaper to maintain than a pension. No actuarial liability sitting on the balance sheet. No promise of a specific future payment. Match percentage, set up the platform, done. Your retirement risk is now your problem. Between 1980 and 2018, the percentage of private sector workers covered by a defined benefit pension dropped from 38% to roughly 15%. The 401k rushed in to fill the gap. But it filled the gap the way packing tape fills a structural crack in a foundation. Technically, something is covering it, but the tension underneath hasn't changed. Because the 401k transfers the investment decision, the withdrawal strategy, the sequence of returns management, the longevity planning, and the tax optimization entirely to you. A factory worker in 1979 didn't need to understand Irma Cliffs. His pension handled that. A 45-year-old today, you are the portfolio manager. You are the risk manager. You are the actuary, estimating how long you'll live. Ready or not, the financial industry would like you to believe this was progress. More choice, more control, more flexibility, and there is some truth in that framing. But it is also, and I find this more funny than infuriating, which is probably a character flaw, an extraordinary transfer of corporate liability to individual workers dressed up as empowerment. Check the label on the extinguisher. And look, I want to get specific here because I think the fee erosion problem deserves its own moment because it's the quietest number. It never shows up as a line item. It never asks you for a check. It just happens automatically every single year, extracted from your returns before you ever see them. The average expense ratio on actively managed mutual funds commonly sold through employer-sponsored plans is somewhere around 0.6 to 1% annually. That doesn't sound alarming. Here is what it actually means in dollars. Take $250,000, invested for 30 years. Market returns 7% annually. With no advisory fee, on top of a low-cost index fund, let's say you're paying 0.05% in fund expenses, you end up with approximately $3.3 million. Now add a 1% annual advisory fee to that same scenario net return of 6%, and you end up with approximately $2.5 million. The fee has cost you $800,000. Not in fees paid out of pocket, in compounding you never received, in future wealth that quietly evaporated because it was never allowed to grow. $800,000. That number never appears on your quarterly statement. Your statement shows your balance and your return net of fees. It does not show you the parallel universe where you kept that $800,000. And your advisor's newsletter has a very nice lighthouse photograph on the cover, so that's something. The reason I'm not angry about this, and I want to be clear that I'm genuinely more amused than enraged, is that the incentive structure makes complete sense from inside the industry. Financial advisors who sell higher fee products earn higher commissions. The products are legal, the fees are disclosed. The disclosures are written in a font and format specifically designed to be skimmed, but they are technically there. Nobody lied to you. The system just wasn't built around your interests. There was a moment when this might have changed. In 2016, the Department of Labor, under the Obama administration, proposed a fiduciary rule that would have legally required brokers giving retirement advice to act in their client's best interest, not in a product that's merely suitable but genuinely best. The financial industry spent enormous resources opposing it. The rule never fully took effect. The distinction between a fiduciary advisor and a suitability standard broker remains, in 2026, largely invisible to most retail investors. Check the label. On the extinguisher. Now, I want to make this concrete because I've been throwing numbers and concepts at you, and the moment this becomes academic is the moment you stop making decisions. So let me show you a realistic scenario. Sarah is 45. She earns $120,000 per year working in marketing for a mid-sized company. She's been contributing to her 401k since she was 28. She's done well by almost any measure. Her current balance is $380,000. She contributes the full $23,500 per year, and her employer matches up to $5,000. She plans to retire at 65. Let's run this forward honestly. 20 years of contributions, $28,500 per year total, compounded at 7%, produces approximately $1.3 million in new contributions alone. Her existing $380,000, compounded over 20 years at 7%, grows to approximately $1.47 million total at 65, roughly $2.7 million. She has done everything right. 4% withdrawal, $108,000 per year, gross. Her effective combined tax rate on withdrawals, federal 22%, state 6% where she lives, puts her at roughly 28%. Net income from her 401k, approximately $77,700. Add Social Security. Based on her earnings history, she qualifies for roughly $28,000 per year at full retirement age. But with $108,000 of 401k income, up to 85% of her Social Security is now taxable. So the real after-tax value of that Social Security check is closer to $22,000, total spendable annual income, roughly $100,000. She was earning $120,000. She's replacing about 83% of her income. That's workable on paper. But that number assumes the market cooperates in her first 5 years of retirement. She stays healthy enough not to incur major out-of-pocket healthcare expenses. Her property taxes and insurance don't escalate faster than her plan assumed, and nothing unexpected happens in 30 years of living. None of those are guaranteed. Any one of them can break the math. More importantly, Sarah has no secondary income stream, no dividend income from a taxable account, no rental property, no royalty, no business stake. No mechanism generating cash flow independent of whether she's working or what the stock market decided to do this quarter. Her entire retirement rests on a single vehicle, a single market, and a single withdrawal lever, one fire extinguisher, pointed at a very large building she plans to live in for 30 years. This is where Craig re-enters the story. Because Craig is Sarah in 20 years, if Sarah doesn't build the second layer. Craig retired in 2023 with $1.4 million and immediately ran into two realities that didn't appear in his retirement projections. First, healthcare. Craig is 66, just barely past Medicare eligibility, but his wife is 62, and she's still 4 years away from Medicare. Her individual health plan cost him $900 per month in premiums, plus out-of-pocket costs. That's $10,800 per year that Craig's retirement model accounted for at roughly $6,000. The gap comes directly out of his withdrawal. Second, 2025 turned volatile. Craig watched his balance drop from $1.4 million to $1.1 million during the first significant correction of his retirement. He started making subtle changes. He moved 15% of his portfolio to cash temporarily. He reduced his travel plans. He's withdrawing conservatively now, but conservatively means he's not living the retirement he pictured. Craig is not in crisis. Let me be fair to Craig. But Craig is managing, and managing is not the same as okay. And managing from a position of one income stream, one lever, one vehicle, one extinguisher means every unexpected expense, every market correction, every healthcare bill is a direct threat to the stability of the whole plan. Well, Tom, what should Craig have done? The answer isn't complicated. It's just unglamorous. While Craig was accumulating inside his 401k, he could have simultaneously been building income-producing assets in a standard taxable brokerage account, not instead of the 401k, alongside it. Every month, after his automatic 401k deduction, an automatic transfer to a taxable brokerage account, buying dividend-focused index funds, no contribution ceiling, no withdrawal penalty, no mandatory distribution schedule, no one telling him when and how much to take out. He would have paid taxes on dividends along the way, yes, but he would have arrived at 66 with a second engine running if that brokerage account had been generating even $1,500 per month dividend income by the time Craig retired, a realistic number for a disciplined saver. Over 20 years, Craig's retirement math looks completely different. His 401k drawdown rate drops. His sequence of returns exposure is buffered. He doesn't need to move to cash when the market wobbles because his income doesn't come only from selling shares. That is the framework I want to leave you with. 3 layers. Not 3 accounts inside the 401k. 3 fundamentally different mechanisms. Layer 1, your 401k. Max it. Take every dollar of employer match that is the only investment on earth that generates an instant 50 to 100% return on the first day. Pick low-cost index funds. Vanguard, Fidelity, or Schwab's own index options all work. Keep your expense ratio below 0.2% if possible. Stop touching it. Stop rebalancing emotionally during corrections. This is your foundation. It is not your plan. Layer 2, a taxable brokerage account with dividend and income-focused holdings. This is the layer most people skip because it doesn't have the automatic payroll deduction convenience of the 401k. You have to actively transfer money into it. That friction is real, and it's the reason most people don't build it. Set up an automatic monthly transfer, even $200, to start and invest it in a diversified dividend ETF. VYM, SCHD, DGRO, they're all reasonable starting points. Don't overthink the specific fund choice. The point is building an income stream with no ceiling and no government-mandated withdrawal schedule. That stream starts small. In 10 years of consistent contribution, it starts to matter. In 20 years, it changes your entire retirement risk profile. Layer 3, one income-producing asset from a completely different mechanism than stock market returns. A rental property with professional management. A small business equity stake that distributes income. A royalty arrangement. A lending position. Something that generates cash flow from an entirely different source not correlated to whether the S&P 500 had a good quarter. This is the layer that makes a difference between managing in retirement and living in retirement. This is also the hardest layer to build, and it doesn't happen quickly. But if you're 35 or 45, you have the runway to do it. The reason almost everyone stays at layer 1 is psychology, not laziness. The 401k is frictionless. The payroll deduction happens before you see the money. You never feel the sacrifice of the contribution because you never held the cash. You set it up once, you forget it, you check the balance twice a year and feel responsible. That psychological ease is real and it's genuinely valuable. Automate the behavior, eliminate the decision fatigue, but it creates a false sense of completion. The 401k is on autopilot, so retirement must be handled. The second and third layers require active decisions. Active decisions feel harder, so people defer them indefinitely, which means they never build them. Most financial mistakes aren't math problems, they're brain problems. The math of retirement is not complicated. The psychology of choosing present comfort over future resilience, over and over, for 30 years, that's the actual challenge. And the 401k was cleverly designed to exploit the one behavioral hack that works: automation. The problem is, they automated one layer and called it enough. Before I close, 3 specific actionable things. Not diversify your portfolio, calibrated to exactly this conversation. First, run the sequence of returns test on your own numbers today. Take your current projected retirement balance. Apply a 30% market drop in year 1 of retirement. Then calculate how long your money lasts at your planned withdrawal rate. If the answer is less than 25 years, you have a structural problem. You don't need a new fund, you need a new layer. Second, check the label on your current extinguisher. Open your 401k plan summary and find 2 specific numbers: your total expense ratio across all your fund holdings and your employer match capture rate. If you're paying above 0.25% in expense ratios on index funds, you are overpaying. If you're not capturing 100% of your employer match, you are donating money to your company that was contractually yours. Fix both of these before doing anything else. Third, open a taxable brokerage account this week. Not next month, this week. Fund it with whatever you can spare after your 401k contribution. Automate a monthly transfer. Pick one low-cost dividend ETF and don't change it for 5 years. The specific amount is less important than the architecture. you are building the second layer. It will feel irrelevant at $200 per month. At month 60, it starts feeling like something. At year 15, it starts being the thing that changes your retirement math. Craig's story doesn't have a bad ending. He's going to be okay. But okay isn't what he planned. Okay isn't what 40 years of disciplined saving was supposed to deliver. He trusted one extinguisher to protect everything. The extinguisher worked exactly as labeled. He had just never read the label carefully enough to notice what it wasn't designed to do. Lazy investing built more fortune than crypto memes. And if the 401k were actually enough, the financial industry wouldn't sell you 27 other products the moment you walk into a bank.